Hello, fellow Rebel Capitals. Hope you're well. So we've got Jerome Powell coming out and talking about the rate decision that is live right now. We're going to cut to it, and I'm going to give you my reaction in real time, and then we're going to discuss today's news. We got a lot going on with ECB, the Bank of. What on earth is that, Josh? Is that Jerome Powell's intro music?
Yeah. I don't know what that was.
We got Brian there in the background. Holy cow. Josh must be having a Jerome Powell watch party out there.
Yeah, that's exactly what's happening.
All right, let's cut over to Mr. Powell himself and hear what he's saying. And then let's compare it to what's going on with Canada and the ECB. This is going to be really cool. Well, he's supposed to be on at 2:30. I know that it is. I can see that guy's head moving. So that's good. And just FYI, I don't know if I went over it, but the decision was to keep rates the same. So that just came out. So now we're going to hear Jerome Powell answer questions. I think the kind of what the final decision was is they kept rates the same, but they had a very hawkish tone. I think the bond market yields are up.
My colleagues and I
Here we go.
Squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong, is strong overall, and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. I'll have more to say about monetary policy.
In other words, QT
policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. For 2024 as a whole, GDP looks to have risen above 2%, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have slowed in the fourth quarter, but was strong for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid. Payroll job gains averaged 170,000 per month over the past 3 months.
Minus revisions. Sounds like he's got a cold. I almost feel sorry for him. It seems like he's under the weather.
Following earlier increases, the unemployment rate has stabilized since the middle of last year, and at 4.1% in December remains low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures.
That's a big statement. I completely agree, but wow. The Fed actually acknowledges that the Phillips curve is kind of, or the wage price spiral is kind of bogus.
Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.6% over the 12 months ending in December, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. Over the course of our 3 previous meetings, we lowered our policy rate by a full percentage point from its peak.
As mortgage rates went up, by the way, and the long end of the curve went up. So there goes the Fed controlling interest rates, at least at the long end.
That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment.
How do you figure, though? Because, again, this is something that they never talk about. That he's saying that, well, if we drop rates too low, well, that might cause a problem with inflation, or if we keep rates too high, that might cause a problem with the economy. But let's remember that the main interest rate in the economy is the 10-year Treasury yield. Not the only one. Obviously, the front end of the curve matters to corporate debt and whatnot. But the 10-year Treasury is paramount, right? And he dropped by 100 basis points, and the 10-year Treasury went up by 100 basis points. So I don't see how he can, with a straight face, say that what he's doing at the front end of the curve really impacts the economy the way he wants you to believe it impacts the overall economy.
In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. As we previously announced, our 5-year review of our monetary policy framework is taking place this year. At this meeting, the committee began its discussions by reviewing the context and outcomes of our previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews. Our review will again include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last.
A research conference in May. Josh, is he talking about Rebel Capitalist Live?
I honestly, I was saving the dates.
I was going to keep it a secret, but the cat's out of the bag, guys. Jerome Powell is going to be at Rebel Capitalist Live. So get your tickets ASAP at rebelcapitalistlive.com.
5 years in determining our findings. We intend to wrap up the review by late summer. I would note that the committee's 2% longer run inflation goal will be retained and will not be a focus of the review. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer run inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Chairman Steve Leisman from CNBC. Mr. Chairman, at a event in Davos, or from to Davos anyway, the president said he'll demand that interest rates drop.
I was just going to bring this up.
Immediately. So I guess I have a 3-part question. Has the president done this to you? Has he made that demand? Secondly, what is your response to that? And third, what effect, if anything, if any, does a president making these kind of remarks have on policy?
Jerome Powell. Nothing gets under his skin more than questions about if Trump controls him. he tends to get pretty pissed off and have some, let's just say, lively answers. I'm looking forward to hearing what he's going to say here.
Thank you.
3 questions. I'm seeing it really as one question though. So I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work. And that's how we best serve the public.
Can you just comment on whether he's physically communicated this demand to you?
I've had no contact. Thanks.
Very measured. Jerome Powell has far more self-control than I do. I'll give him that for sure.
Nick Timmeros, The Wall Street Journal. Chair Powell, you and several of your colleagues said around the time of the last meeting that your policy stance was meaningfully restrictive. Given economic and financial market developments since then, how has your confidence changed in an assessment that says interest rates are meaningfully restrictive?
I don't think that my assessment really has changed. I mean, a couple of things have happened. We've gotten more strong data, but we've also seen rates move up at the long end, which could represent a tightening in financial conditions. I think if we look back over the past year or so, we can see that policy is restrictive. If you look at the effect of high rates on interest-sensitive spending, for example, in housing, and if you look at the achievement of our goal variables, we're seeing the economy move toward 2% inflation and has moved largely to maximum employment. So we really look at the movement toward the goal variables to make that assessment.
I'm curious if someone's actually going to ask him or point out, Mr. Powell, you've dropped rates by 100 basis points, but the long end of the curve, the 10-year Treasury, has gone up by 100 basis points, and you just admitted that could be, on net balance, tightening of financial conditions in the economy. So why are you so confident that if we need to have looser monetary policy, we will actually get that by you dropping the front end of the curve? Isn't there a scenario where you continue to drop because of financial weakness in the economy, but the long end of the curve just continues to go up and up and up, representing further constriction of the economy or financial conditions, which would lead to the opposite of the intention? I wish someone would just kind of call him out. I mean, let's put him on the spot here. Let's put him on the spot. If rates have gone up in the past by 100 basis points, when you dropped 100, that's a 200 basis point spread. So in the future, are you confident that tool that you have at the front end of the curve will actually loosen financial conditions when it has tightened financial conditions over the past 2 or 3 months? Let's ask him the tough questions.
Now, policy is meaningfully less restrictive than it was before we began to cut. It's 100 basis points less restrictive. And for that reason, we're going to be focusing on seeing real progress on inflation, or alternatively some weakness in the labor market before we consider making adjustments.
If I could follow up, does the economy here warrant meaningfully restrictive interest rates? And would you judge interest rates to still be meaningfully restrictive if you were to lower them by another quarter point?
So I think our policy stance is very well calibrated, as I mentioned, to balance the achievement of our two goals. We want policy to be restrictive enough to continue to foster further progress toward 2%.
Isn't it weird? It's like that emperor is wearing no clothes type of moment, where even Timmeros doesn't call him out on it. That even Powell said, even admitted that long rates went up, and therefore that could have been perceived as tightening of financial conditions. So, but then the very next question Timmeros asks him assumes that if he drops rates, then that's somehow going to loosen financial conditions. It's just, I just wish there was that kid in the crowd that just asks the question that is so blatantly obvious.
Inflation goal. At the same time, we don't need to see further weakening in the labor market. to achieve that goal. And that's kind of what we've been getting. The labor market has really been broadly stable. The unemployment rate has been broadly stable now for 6 months. Conditions seem to be broadly in balance. And I'd say look at the last couple of inflation readings and you see we don't overreact to two good readings or two bad readings, but nonetheless, the last couple of readings have suggested, more positive readings. So I think policy is well positioned.
Colby from the New York Times. Colby Smith with the New York Times. Chair Powell, how should we interpret the removal of the line from the statement that inflation has made progress towards the 2% goal? Is that no longer the case?
No. So let me look. If you just look at the first paragraph, we did a little bit of language cleanup there. We took out a reference to since earlier in the year as it related to the labor market. And we just chose to shorten that sentence. Again, I mean, if you look at the sort of intermeeting data, it was good. And there was another inflation reading, I guess, just before the December meeting. So we've got two good readings in a row that are consistent with 2% inflation. Again, we're not going to overinterpret two good or two bad readings, but this was not meant to send a signal. Other than this, you can.
Josh, I want to do a quick check-in on the CNBC homepage to see how markets are moving. My guess is the S&P 500, NASDAQ down, and interest rates up. I know you guys aren't going to see this, but let me just give you an update here, and then we'll get back to Powell to see how markets are moving or responding to what he's saying. Now Dow, S&P, and NASDAQ all down, but just slightly. And then I'm assuming interest rates are up, which they are, but again, just slightly. So not too much movement on what he has said so far.
Take away from all of this that we remain committed to achieving our 2% inflation goal sustainably.
And just to follow up, we've seen inflation expectations across a number of measures rise sharply, which has in part been linked to tariff concerns. But there's also been this encouraging data that you mentioned in terms of CPI and rent indices. So how would you characterize concerns about upside risks to inflation across the committee, especially those tied to policies related to the Trump administration?
Well, I'd say you see expectations moving up a little bit at the short end, but not at the longer end, where it really matters. And those could be related to what you mentioned, some of the new policies. I think where the committee is very much in the mode.
I think he obviously misspoke right there, because if I heard him correctly, he said it's all about inflation. He said you're not seeing concern at the long end, but that's actually where you are seeing concern. Or maybe he's just talking about the past month since, we peaked out at 4.8 and have gone down slightly.
Of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy. We're only just beginning to see, and actually are not really beginning to see much. And I think we need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. So we're going to be watching carefully, and as we always do. This is no different than any other set of policy changes at the beginning of an administration. We'll patiently watch and understand, and kind of not be in a hurry to get to a place of understanding what our policy response should be until we see how it plays out.
I think that's pretty rational.
Michael McKee from Bloomberg Television and Radio. You and your colleagues normally condition future policy moves with the phrase, if the economy develops as we anticipate. Is it fair to say that since there's a lot unknown about what this administration's fiscal policies are actually going to be, that you don't have a medium to long-term economic forecast that you can have confidence in? Or if that's not true, can you lay out what you think is going to happen in the economy, how you see it developing?
Well, at all times, forecasts are conditional at a minimum on just a set of expectations, and they're highly uncertain in both directions. We know that economic forecasting is really difficult beyond just a month or two out. So in the current situation, there's probably some elevated uncertainty because of significant policy shifts in those four areas that I mentioned: tariffs, immigration, fiscal policy, and regulatory policy. So there's probably some additional uncertainty, but that should be passing. We should go through that, and then we'll be back to the regular amount of uncertainty. So, you know, what forecasters are doing, not just us, but everybody's doing, is they've got sort of just a set of assumptions about what might happen, but they're really kind of in the nature of a placeholder, and meaning, you know, plausible could be, but honestly, you wouldn't stand behind it because you just don't know. And so you're just on hold waiting to see what comes down. You know, it's a very large economy, and policy is affected at the margin, but we're going to wait and see.
If I can follow up, the idea that you feel the policy is restrictive suggests that the Fed in general wants to continue to lower interest rates. So when you look at the data that you are dependent on, are you looking for data that tell you that you can cut, or data that will tell you you should hold?
You know, we're looking. It's more the way it works is we are looking at the data to guide us in what we should do, and you know, that's what we do. And right now, we feel like we're in a very good place. Policy is well positioned. The economy is in quite a good place, actually, as well. And what we do expect is to see further progress on inflation. And you know, as I mentioned, as we see that, or if we were to see weakening in the labor market, that could foster. We could then be in adjustments. But right now, we don't see that, and we see things as in a really good place for policy and for the economy. And so we feel like we don't need to be in a hurry to make any adjustments.
Okay, I think that's pretty much the gist of it. We get it. What I'd like to do now is go over some of the other central banks around the world, the ECB and the Bank of Canada, and seeing what they're saying and what actions they're taking in regards to interest rates. And I really want to focus on Germany as well, because this takes us back to a question we've been asking on this channel for a long, long time. How long can the United States remain the outlier as far as the economy? It maybe forever, maybe not. But I think it's something we need to be cognizant of. I think we need to be very cognizant of what's happening around the world, not just within the United States. So on that note, let me switch up the screen share. And let's go right over to the CNBC homepage. And I want to start with what's happening with the ECB. They cut rates again, looks like today, and they're using the excuse of the threat of tariffs and whatnot, when in all reality, this is because their economy is not doing well. You'd say economic contraction, lower rates of growth, or you could just say outright recession. I don't know, you know, it depends on how you calculate the numbers. But what's happening in the European Union, especially in Germany, is not good. So the title here is European Central Bank Cuts Rates Again with Trump Threat and U.S. Divergence in Focus. ECB is set to kick off 2025 meetings with another interest rate cut on Thursday. Oh, excuse me. Okay, so this is for tomorrow. That's the expectation. Money markets were on Wednesday pricing in 35 basis points worth of rate cuts for the January meeting, indicating Eurozone will cut by at least a quarter percentage point. So they're saying that they might cut by 50 basis points. The key question is whether the ECB is comfortable with the increasing distance between its own monetary path and the world's biggest central bank. So again, what you have to do is you have to go back and look at when we've had divergence between these major central banks, and it's not often. Usually they're going in the same direction to a greater or lesser degree, especially when you look at the United States and Canada. More on that in just a moment. Market pricing then suggests follow-up cuts at the ECB's March and June meetings, with a fourth and final reduction bringing deposit overnight rate to 2% by the end of the year. And I would probably put my money on the under there. And I also want to point out that with going back to what the Fed is doing right now, this is the first divergence we have seen as far as the rate cutting cycle going back to 2007 and 2008. Remember, they started on September 18th. They started from 5.25%, and then they started in the first part of the rate cutting cycle by cutting 100 basis points, just like they did in 2024. But now we've seen a big divergence, so we'll have to see how that plays out. I wanted to mention that when we were watching Jerome Powell, because in January of 2008, they continued to cut. And not only cut, they cut by, I think, 125 basis points alone in January, where this time they had a pause. So the start of the cycle was identical, but now we're going in different directions. So the question is this time completely different, or is this time similar and the Federal Reserve is completely off sides, which would be consistent with what is happening in the global economy? Getting back to this here. I want to go over to Germany because I think that's a big story. And they were really suffering, but they, once again, even though I believe they're, let's see, why did we not? Here we go. Titled Germany Slashes Growth Outlook. And keep in mind, this is the biggest economy in the Eurozone. And I believe it's the third or fourth largest economy in the world. Germany slashes growth outlook in serious diagnosis of Europe's latest or largest economy. Key talking points: the German government on Wednesday slashed its GDP forecast to just 0.3% for 2025. This is down from the previous. Geez. Boy, slashed is an understatement. Look at this. It's now 0.3%, and it's down from a previous forecast of 1.1%, but broadly in line with estimates from the IMF. So they say the diagnosis is serious. Robert Habeck, Economy and Climate Minister. Oh, geez. That should definitely be separated, like church and state. Said during a press conference, according to CNBC translation, he noted, while there are some positive developments, such as rising demand for credit, Germany is stuck in stagnation. Now let's go over to the Bank of Canada, because we rarely see divergence. And we rarely see divergence with any of these major central banks, but especially with the Bank of Canada and the Fed. So right here, Bank of Canada cuts rates, says tariffs could stoke persistent inflation. The Bank of Canada on Wednesday trimmed its key policy rate by 25 basis points. So they did cut today down to 3%. The cut growth forecasts and so they cut growth forecasts just like Germany and said it was concerned with U.S. tariffs. See, Donald Trump is promising to impose 25% tariff on Canada starting Saturday. Canada sends 75% of all goods and service exports to the United States. I mean, that will most likely negatively impact them, but it's also going to negatively impact the United States. I mean, the idea here is we set up these tariffs and all of a sudden that we just start producing all the stuff that we're getting from Canada here in the good old US of A. Not really. It takes a long time, even if that's the way it plays out. Now, maybe he's just using this as a negotiating tool to get something else. I hope he is, because if it's not, if it's an economic policy, you guys know my feeling on that. On net balance, although there are some benefits, on net balance, it doesn't make sense. It usually just hurts Canada, or it hurts both countries as far as the average Joe and Jane. A long-lasting and broad-based trade conflict would badly hurt economic activity in Canada. This is according to another quote-unquote expert up there. They say what we don't want to see, though, is that initial price levels increase, start to feed through broader. Yeah, I don't know if I'd be. Yeah, if I was Ken, I don't know that I'd be worried about that. I'd be worried about economic growth. I don't know that I'd be worried about this creating persistent inflation. I don't see how, unless they're talking about increasing tariffs on the United States like a tit for tat, which would make sense. Usually, I mean, just go back. It's not like this is the first time Trump did tariffs. I mean, I think everyone forgets that he did them back in 2018. And, what was the result back then? Not much, to be honest with you. You could say that prices were higher than they otherwise would have been, but we definitely didn't see massive broad-based consumer price inflation. But you could also argue that those tariffs were more targeted than the one that he's proposing now in 2025. Noting a hypothetical scenario, the bank said its monetary policy report, that if Canada and other nations slapped a 25% tariff on the United States in retaliation, this could cut Canadian growth by 2.5 percentage points in the first year. Yeah, but what would it do to the United States? It's not like we would be completely unaffected. And, again, maybe your argument is that it would be an economic boom for the United States. Okay, but that still has some sort of economic impact that I'm surprised they're not discussing. The Canadian dollar was weaker right after the decision. That's another thing too, that if, I don't know that long-term FX really depends, or cross rates really depend on tariffs. I don't see any evidence for that. But in the short term, this is the way markets move. So it's an interesting juxtaposition when you're throwing on these tariffs, assuming that he implements them. And there are these, broad-based tariffs, and this could increase the dollar, the value of the dollar, let's just say on the DXY, and that's going to make manufacturing that much more difficult for the United States producers. So it's almost like you're shooting yourself in the foot there. So I haven't heard Trump address that specifically. I don't know if he's even thought about it, but it'll be interesting to see what he says if these tariffs do lead to the dollar continuing to go up against these other currencies, which the United States, or the manufacturing base here, theoretically, is supposed to be competing with. And these tariffs, remember, are supposed to give them an advantage. Well, maybe you are getting an advantage, but you could argue you're getting a disadvantage from the dollar going up, and therefore, on net, is it a positive or negative? Let you be the judge. Here's where we get into the divergence from the Fed, and I think we should be asking ourselves, how long can this continue? And if we see that divergence mean revert, like we have in the past, would that mean the Bank of Canada raising rates, or would that be the Federal Reserve lowering them? The BOC, Bank of Canada, which has been among the most aggressive top central banks in cutting rates, trimmed the country's economic growth outlook to 1.8% in 2025 from 2.1. So not as a significant decline as we saw in Germany. The economy will grow by one. The economy will grow. They're predicting the economy will grow by 1.8% in 2026, down from growth 2.3 earlier. The central bank lifted its forecast for inflation to 2.3 from 2.2. Okay. I don't know if we can put any weight on that. Yeah, a tenth of a percent. Okay. It's amazing how accurately they can predict things down to the 10th of a percent, but they never, ever, ever see something like the GFC coming. Let's go back to the homepage and see what markets are doing. Okay, now they're down a little bit more than they were before. The Dow is down 0.3%, S&P down 0.5%, and NASDAQ down 0.7%. Bonds bonds are down slightly as far as yields from when we checked in with them last time. For the Bitcoiners, it's up a bit. Gold bugs up slightly, and oil down 1%. Okay, so that would lead me to believe that the oil market is saying, okay, this is going to be bad for demand. One more thing I wanted to discuss, Josh, was the world's largest sovereign wealth fund right here. And this is a separate topic. It goes back to kind of what we've been hearing in the news about DeepSeek and the NASDAQ, these tech companies, more specifically NVIDIA. I mean, everyone was expecting NVIDIA to really bounce right back to where it was, buy the dip, buy the dip. But what we're seeing with NVIDIA is maybe buy the dip isn't the right thing to do, because we are not seeing the recovery. We are seeing exactly what you would expect from the price action if your conclusion is the probabilities are high that price continues to go down. Let me show you exactly what I'm referring to. See if I've got, I do have that up on trading view. This is perfect. So let's go back just 5 days. And we got this just massive, you guys know what happened here. You've been following the news. And then yesterday we saw it bounce back, but today we see it down let's see, 5.5%. So down $7. So we're not yet at the lows that we saw that first day when it just completely fell out of bed. That was 118. But we're back down to 122. We bounced yesterday up to 128. So if you can think about this, let's zoom out here. All right. I think this better illustrates what I'm talking about. We had this crash, for lack of a better word, and then we had this dead cat bounce, or what I think will likely be a dead cat bounce based on the price action today. So why is this? Well, you've got several things going on here. You've got, buy the dip, buy the dip, buy the dip. And like we said in the past videos, this is how people go bust. It's because they don't just buy the dip. They buy the dip all the way down to a point where they have to capitulate, and they take massive, massive losses because they continue to think that, this is the buying opportunity. This is the buying opportunity. And it kind of just, it's like the market sucks you in and it crushes the maximum amount of investors possible. But also, the shorts are covering. So shorts likely made a lot of money in this one day. And so they're covering, plus you've got buy the dip, but at a certain point, that buying activity fades. And when that buying activity fades, then the selling pressure continues. And then you see a day like we saw, or we're seeing play out right now. And the big question is what happens next. Usually when you see price action like this, you just, nothing goes down a straight line, but you see kind of bigger moves down. And we'll have to see what happens into the end of this week and into next week. But I would not be, my base case right now, not that I'm an expert at picking stocks, but based on what we're seeing here, my base case would be it's probably headed near 110 or 100. So how does that play into this? World's largest sovereign wealth fund reports record 222 billion annual profit on tech rally. Okay, and I would imagine that a good majority of their 222 billion in profit, that's a lot of purchasing power, isn't it? A lot of purchasing power. But I'm just curious how much of that purchasing power they've lost just over the last few days, right? Because my guess is this, well, it's not a guess. It definitely didn't include what happened more recently, because this is full year profit for, let's just say, well, I'm assuming it's for 2024. Yeah, it is right here. The fund's 2024 profit surpassed the record set earlier. So my point here is we go back to the balance sheet recession that we had during the dot-com bust in 2000 and 2001. And what's important to note is that was not something that was exclusive to the United States as far as the economic recession, although it was a result of something that was in the United States, U.S. equities. and the NASDAQ and the .com stocks. Why? Because it impacted so many more balance sheets outside of the United States that it also impacted aggregate demand in those local economies because so many foreign balance sheets had exposure to the .com bubble. So this is an example of balance sheets that have massive exposure to, let's say, the Mag 7. So if that goes down, it not only impacts the United States economy, but it massively impacts other economies. And going back to our earlier discussion, economies like Germany that are already getting kicked in the nuts from a standpoint of the economy, economies like Canada, and economies that are really, really suffering right now outside of the United States. So I think just NVIDIA is a proxy for that. And that's why this is such an interesting story to me. And it's something that I think we need to watch very closely. All right, guys, I want to remind everyone that tomorrow, drum roll please, is my birthday. That is right. And you guys can attend a free virtual conference I am doing to talk to some of my best buddies on what their predictions are for 2025. So who am I talking about? Well, I'm talking about guys like Kenny McElroy. We're going to be talking about real estate. What does he see? He's got 10,000 doors, for heaven's sakes. He manages about 1.5 billion in multifamily properties. So if anyone knows what's going on with rents and with housing, residential, it's going to be Kenny McElroy. We're going to be talking about that tomorrow. Joseph Wang, we're going to be talking about the Fed. It'll be nice to get his insights on what Jerome Powell was saying today. With Brent Johnson, we're going to be talking about the dollar. Obviously, that's one of the most important things that we have to pay attention to going into 2025. And then McIntosh, we're going to be talking to him about global macro and commodities. So this is something you don't want to miss. It's a free virtual seminar. You just go to georgegammon.com/birthday, and you go ahead and sign up with your email. This is how we grow the email list. You get the link. You can tune in live, or if you don't make it live, you can use that link to watch the replay. So go to georgegammon.com/birthday right now. Make sure you sign up. And on that note, make sure you enjoy the rest of your afternoon. As always, make sure that you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.